OGRA has put together a number of videos to answer questions municipalities have about MDW and asset management. This video is on the Asset Valuation Module of MDW. The Asset Valuation Module will capitalize and amortize the gross book value of an asset over the user-defined useful life of the asset. The AV Module groups like assets together into categories using user-defined criteria. That is, municipalities can, for example, group roads together by traffic volume, type of surface material, functional class of the road, being arterial, collector, or local residential, or any other criteria that the municipality deems appropriate. To that category of asset, the user can determine the amortization and valuation methods and set the capitalization threshold. The module will capitalize and amortize the asset based on information recorded as a lifecycle event total cost for each asset record. Three important lifecycle event categories are construction, which begins the amortization process and is used for new assets, rehabilitation, used for betterments to an existing asset, and TCA adjustment, used to write down, write up, or dispose of an existing asset. The Asset Valuation Module uses the total cost information recorded in the lifecycle event for each asset record. That $1 million that I have highlighted at the bottom of the page will be considered a betterment to the asset because this is a rehabilitation lifecycle event, and that $1 million that is highlighted will be capitalized and amortized over the user-identified useful life. The lifecycle event date is the date the module uses to capitalize and begin the amortization of the asset. If you're using the half-year rule, the lifecycle event date will be July 1 of the year. If you're using the full year amortization, then you would use January 1 of the year, regardless of the date the actual work was completed or the asset was improved or purchased. The adjusted replacement date is used to extend the useful life of the asset. In this example, the lifecycle event was a 2011 event. The adjusted replacement date must reflect the time frame over which you want to amortize this betterment to the asset. Without an adjusted replacement date, the 25-year betterment to the asset would be amortized over the remaining useful life of the original asset. With an adjusted replacement date, that same betterment would be amortized, in this example, over an additional 10 years. The adjusted replacement date is also used for a disposal to force the write-off to zero. In this example, the net book value of the asset at the end of 2013 is shown in the AV report as $16,500. On April 21st, 2014, the asset is traded in and the municipality received $15,000 as a traded amount and recorded that amount as a lifecycle event. Let's assume there was 2 years left on the useful life for that asset. Without the adjusted replacement date, the $1,500 difference would continue to amortize until the end of the asset's useful life. We've had a number of questions with regards to why would I want to include a business group. And business groups are a method of grouping assets together for reporting purposes. There is a tangible capital asset report by a business group that can be used, and in this example you will notice for the TCA account equipment and furniture there are 14 equipment assets in this particular account totaling $81,875. If you look further down the page to TCA account machinery and vehicles, there are 6 equipment assets totaling $125,534. This report is generated by attaching a business group to each asset record in the inventory, thereby producing this report without having to go in and manually place the assets into each category. If you have any questions after viewing this video, please give me a call or send me an email. Thank you.